Love to see it. Hello, ladies. All right. Well, it's Friday, February 20th, and what would you want to talk about aside from taxes, right? So that's why we're all gathered here today to give you some practical tips about how to plan for taxes, not just for your filing of your taxes this year, but year round. If you're working with Brio, we're already doing a lot of the strategic tax planning with you and for you, but we also want to help edify you in general on all the stuff that we are doing and you can be doing to minimize your tax burden. So with that, we've got wealth advisor Jamie Alpa here. He is our resident tax dork, and I say that lovingly. He loves this kind of stuff, is so in the weeds, loves that tax code, reads it to go to sleep. And we've got also joining us Associate Wealth Advisor Vivian Segura, who is going to just charm us with her knowledge of taxation. So, with that, I will pop it over to my two colleagues, Jamie and Vivian. But remember, this hour's for you all. If you have any specific questions, feel free to just raise your hand, speak up, and we'll answer the questions best we can real time. All right?
Great, thank you, Shannon.
Uh-huh.
Yeah, and then Shannon, if you want to monitor the Q&A
On it.
box, sounds good.
Oh.
Uh, yeah, we can answer some questions along the way, but ideally we wait mostly to the end. We don't have time to go very in depth into each topic. I was telling Shannon each one of these slides could probably be an hour on its own. So we're going to stay a little bit high level, but answer some high level questions at the end. And then if you still have questions or want to dig deeper, then bring it to your advisor. If you don't have an advisor, you should, and you should hire Brio. Um, but yes, so let's get started. All right, so important disclaimer to start. We are not CPAs, so we can't give direct tax advice, but we can do tax education, bring some awareness to different topics that you might want to look out for. But we do some tax planning in the sense that we do look at your lifetime tax bill. And we try to create some strategy, and then we like to work with your CPAs to kind of confirm that, yes, this will work for you in certain regards. So, yes, we're not tax professionals. Okay, so Vivian?
Okay, so what is tax planning? So there's two aspects of it that we look at here at Brio. We have tax prep versus the actual plan. And prep, we're just looking at the past. Everything up to this point is what we're reviewing, right? And then your planning is shaping your future. So what can we do a year from now? What your taxes could be from 2 years from now? In retirement, wherever you're at, wherever your future is, that's your planning part. And there's actually three levels of tax planning in general that we can control. And we'll go into greater detail on each of these as we progress through this entire presentation. So the first lever you can look at is your timing. So those are your income, those are your deductions and your gains in terms of, when do we want to take those gains? When do we want to take that income? We have things like character. So what kind of income is it? Is it ordinary income? Or are we talking about capital gains? Or are we talking about tax-free income? And then lastly, we have location. And that's essentially where are the assets sitting? Are we looking at an IRA? Are we looking at a Roth IRA? Are we looking at a trust account? Is it a business account? That's what we're looking at when it comes to location. And as far as planning goes, it's ongoing. We don't just do it once a year and it's over with. We're constantly looking at it. We're constantly thinking about it in the back of our heads. And whenever you come in with a request, that's the first thing we're most likely looking at. Okay. And then we have what we call the tax stack, right? And the first aspect of tax stack is your ordinary income. And that includes things like W-2 income, self-employment income, your pension, your Social Security, and those have tax rates that range from anywhere from 10% all the way up to 37%. And then we have our preferential layers. So those are our preferred income just because they have better tax rates. And that includes things like long-term capital gains and your qualified dividends. And those rates can range from 0% up to 20%. We have invisible taxes. So those are the things kind of in the back end that you don't get to see right directly in your face. And they're not coming out of your pay stub like a federal or state taxes do. And that includes your net investment income tax, or your NIT. And that's pretty much 3.8% on investment income over the threshold. We have your IRMA, or your income related monthly adjustment amount. And that's referring to your Medicare's Part B and D premiums. We have things like phase outs, and those include, your education credits and your child credits, IRA or Roth IRA eligibility, and that's all determined by your MAGI, or your modified adjusted gross income. And then we have, your ACA cliffs, or your Affordable Care Act cliffs. And I believe it's 400% of the federal poverty limit. There is no subsidy, but that's just today. It could change, next year or the years coming. And then lastly, we're looking at your marginal versus your effective tax rates.
What's that?
Yeah.
What's that mean?
Your marginal tax rate, I get these confused a lot.
I could take it, Vivian. So our marginal rates are the rates that she mentioned earlier. So for ordinary income, it starts at 10%, goes up to 37%. So say you're in the middle, your 24% is the last dollar you earned was taxed at 24%. That doesn't mean all of your dollars were taxed at
Ah,
24%.
yeah.
Yeah, your first dollar to 10 and so forth. And so if you average those, that's your effective rate. So, so if your marginal rate is 24% and you're looking to do withholding and optimize your withholding, you might do the math and say, well, last year my effective tax rate was only 17%. So if I withhold, say, 18%, just kind of round up, on all sources, then, without any major changes, you should have a little bit of a tax refund.
Okay. Follow up. How can I get the 0% rate?
Make as little as possible.
Oh, I'm already doing that.
Yeah. No, sorry. So technically, when we're talking about ordinary income, really is a 0% rate because you have your deductions that could bring you to a zero tax liability.
True.
So that's, if you only take the standard deduction and say you're a single filer, you're at about 16,000 for your standard deduction. It's double for married filing jointly. And then if you itemize, it could be greater than that. So if your ordinary income is below that level, then you would pay 0%. But then as Vivian mentioned, the long-term cap gains and qualified dividends, if you hold stock for at least a year and 1 day or any asset, then it's treated as long-term capital gains. And that 0% bracket is really, really great. And we'll talk about it more in a bit. But if you have, let's say you have an in-between year, you just retired, for whatever reason your income is lower, there's quite a range, and I don't have the exact numbers in front of me, but you can look up the tax tables online. It's roughly $45,000 for single filers and double that for married filing jointly. If your income is below that, you might want to realize some of your gains because you're going to pay that 0% bracket,
Yeah.
right? So that's a huge thing for tax planning that people overlook. Um,
And can you go beyond that? It doesn't matter how many years beyond that 1 year.
but what do you mean?
No, never mind. We'll move on.
Okay. Yeah, every year you're starting with different tax
Gotcha.
stack.
Gotcha.
Yeah. Okay. So income timing strategies. Okay. So so we've got generally three different buckets. We've got our traditional pre-tax or tax deferred account. So that's like a 401k, 403b, IRA. Um, and all of that is you earn the money in the current year, but you're not paying taxes on it in that year. So you're was that
I think that's just
that a
some
question or is
noise.
that just some background noise?
You know
Okay.
what's going on here with the teachers? Yeah,
Okay.
Leslie Smith,
they want this tax
do
rate.
you mind muting
Yeah, I got
yourself?
it. I got it. I got
Okay,
it.
thank you. Yeah, so then we have so that's you earned it in the current year, but you say, I don't want to pay taxes on it this year. I want to let it grow tax deferred. So that's a traditional account. Roth is I want to pay it in this year. but then I want to let it grow tax-free. We are limited to how much money we can put into these accounts, but that is a huge component of income timing is do we want to put it in pre-tax, pay taxes in another year, or Roth, pay it today, let it grow tax-free? And then we have just our taxable brokerage accounts. So it's going to grow. Ideally, it's going to grow. It could drop, I guess. But then you're going to pay capital gains tax on the growth or the loss based on when you sell it. So again, this is timing. So when do we want to sell it? And then also, do we want to wait at least a year and a day? Because that's going to give us the long-term capital gain treatment versus the lower, versus short-term capital gains. And for federal, short-term capital gains is the same tax bracket as the ordinary income tax bracket. So if you held a stock for exactly 1 year, that's considered short-term. And so you could say pay 24% if that's your marginal tax rate on that stock sale. But if you held it for just 1 day longer, it would be long term, and then you sell it, then that would be, probably 15%. 15% is a very wide bracket, um, or potentially zero. So very important consideration there. And then we have things like Roth conversions where we can move money from a pre-tax account to a Roth account. That's all it is. But what's happening is you're paying the taxes in that tax year. Um, and so we can strategically do that. Say we're again, we have a low income year, so we're in a lower bracket. Say we're normally living in the 32% bracket, but we had we took off some time from work and now we're going to be in the 24% bracket. Well, we might want to actually do a Roth conversion to fill up that 24% bracket because if we waited till the next few years, we might be realizing those gains or pulling money out at the 32% rate, right? So we just want to look long term and take advantage where we can. Um, yeah, and so widower years. I'm going to mention this later. I've got a graph that will explain this, but so I'll move on. And then earned income. Some people can control the timing of their bonuses. Not everybody can, but that can impact, will that add up into this year versus next year? Some people have access to deferred comp plans. Um, and then if you're self-employed, then you have a lot more control over those type of things. So you can really decide, I'm going to pay myself a bonus next year. Um, yeah, and then retire, and then there's a lot of things in the year of retirement that we'll get into. And then we've talked a little bit about capital gains timing already. So tax gain harvesting is what I was referring to before, where if you have you're in that 0% bracket, it would behoove you to sell stock generally, I should say generally, to sell stock to realize gains up to fill up that 0% bracket. And then you can buy that right back, buy that same stock back. So if it was tax loss harvesting, which you might have heard of, which is realizing losses in a down market, and you can use those losses to offset other gains and reduce ordinary income by up to $3,000 per year. But tax gain harvesting, sorry, with tax loss harvesting, you cannot sell and then buy back that same position within 30 days. Otherwise, that's considered a wash sale, and you lose that benefit. For tax gain harvesting, they don't have that rule. So you can buy back that same exact stock, and what happens is you're increasing your basis. So again, the basis is like what your ownership in that like the money you've put into that asset. And so when you go to sell, you're going to pay taxes on the difference between the fair market value and the basis. So whenever we can increase the basis, that's generally going to be a good thing, especially if it's free. Yeah, so let's keep moving. All right, so then we get into deductions and credit optimization. So I mentioned itemized versus standard deduction. You take whatever one is higher. Itemized deductions are things like the SALT cap, which just increased from 10,000 to 40,000, depending on your income. If you're over 500,000, then you start to lose that benefit, but most people are below it. So that's
Jamie,
going to be,
can you share with everybody what the salt cap is?
oh, sorry, state and local taxes. Yeah, so living in California, for example, you probably pay a fair amount of state taxes. So that can show up on the Schedule A, which is your itemized deductions. And so previously you were limited to just $10,000. So if you were over that in the past, you'll on your 25 tax return, you should see a nice little surprise that it should be over that 10,000 level. Then there are other things like medical expenses, the mortgage interest payments, charitable giving. So say for example, when you look at your itemized deductions, say you contribute $3,000 to charity every year. You're a big charitable giver. But you come up about $1,000 short of the standard deduction between all of your itemized deductions. So there is no charitable benefit, which is actually just starting in 2026, there is now a benefit of up to $2,000 for non-itemizers. So it's brand new in 2026. So save your receipts if you haven't been in that habit. But what you might want to consider too in this example is bunching your charitable deductions into 1 year. So say 1 year you kind of move forward the $3,000 next that you were going to do next year into the current year. So you're making a $6,000 charitable contribution. So now you're $5,000 over the standard deduction. So you're able to take that increased deduction, and then next year you just take the standard deduction again. And so net on deductions, you're winning by 5,000. Um, Again, it's not quite as straightforward now that there is the non-itemizer charitable giving deduction. So that is great. You should definitely consider that. One other new thing with the new tax bill that passed July of last year is that there's now a 0.5% of adjusted gross income floor. So you have to exceed that amount. So if your income was 100,000 and you then the first $500 does not count on your Schedule A. It's the same thing that already occurred with medical expenses. The floor on that is 7.5%. So that's why you generally don't see it show up unless you're making significant medical expenses. Okay. Now, one of the ways to do some of these bunching strategies, and another way to view bunching, besides just combining charitable giving into 1 year, is to do all of your medical expenses in the same year that you do all of your charitable giving, to bunch those different categories all in the same year as well. Some people also have control over the timing on their property taxes. So that definitely is a consideration. Um, Now, a donor advised fund is a really good tool that if you want to do those bunching of charitable contributions, you can donate to a donor advised fund, get that tax benefit in the current year, but then you can continue to make your, semi-annual grants to different charities. So it kind of separates your tax benefit from your from the charitable giving.
All right,
Okay.
Jamie, we have a clarification question. Could you
Yeah.
go over again non-itemizer, the 2,000 versus 4,000?
Yeah. Okay. So starting in 2026, previously there was no benefit if you gave to charity and didn't itemize. There was briefly during the pandemic, and um, and so they kind of brought that back in a bigger way because I think it was like $300 and $600, but now it's. Let me get back to you on the amounts. I think it's 2,000 um, for non-itemizers. Let me just look this up real quick. $1,000. So it's $1,000 for single, $2,000 for married filing jointly.
So if I did $4,000 worth of charitable giving, I can just declare, and I'm single, I do the 1,000.
Yeah, you get 1,000 unless you're able to itemize.
I can itemize.
Yeah, so then you'd follow that format, which
Okay.
is you lose the 0.5% of your AGI benefit, but you'd be able to do the rest of it. So likely, if it's $4,000 in that example, you get more benefit than the 1,000.
Well, when you do my taxes, Jamie, you can figure it out however you like.
Sounds great. Uh,
Yeah, so Sandy, this is as Jamie's explaining, this is a newly introduced deduction for charitable giving. So
mhm.
it is new this year.
2026. Some of the provisions in the new tax bill took started last year, like the SALT cap increase. The charitable giving changes took place this year. Okay, keeping it moving along. Ch Qualified charitable distributions. This starts at age 70 and a half, and if you're charitably inclined, this is what you really want to look at because it's going to reduce your AGI. So, and it's probably take a step back on the 1040. The way it generally flows is you take all of your income sources, that's your total income or gross income. Then you have two, maybe three rounds of deductions before you get your taxable income, and it's the taxable income that actually goes through the tax brackets. So after the first round of deductions, this is above the line deductions. These are things that not a lot of people actually do take those, but it's HSA contributions is kind of the most popular one, I'd say. Alimony, depending on when you were divorced. Um, Certain things with the military. So a little bit less common, but that affects your adjusted gross income. And then you can modify your adjusted gross income to have modified adjusted gross income, also known as MAGI, which we'll talk about a few other times here. And that number is really important. You can view that as like halftime on the tax return, and that impacts a lot of the deductions and credits that you qualify for. Okay, so then after your AGI, you have another round of deductions. That's your itemized or standard deduction. And then the third category is some of those new deductions. We've had the qualified QBI, qualified business income deduction, which generally applies to people who own businesses. You might see a little bit flow through your investments. But otherwise, the new ones are the no tax on tips, no tax on overtime. Those are kind of the below the line deductions, kind of this third category. The new charitable non-itemizer charitable deduction, that's also one of the below the line. Um, yeah, so the qualified charitable distributions, that's going to decrease your AGI, right? So that's going to affect your Medicare premiums. It's going to affect your taxability of your Social Security income. So it's really good. And instead of, say, selling some of your investments to be able to um, make a charitable donation in cash, you're going to have to pay taxes on that sale as long as it's a gain. But if you did it directly th from a pre-tax account, then you don't ever have to pay those taxes. And similarly, if we're not 70 and a half, or we're just looking at appreciated securities versus cash, kind of the same thing. If we just donate the appreciated securities, then we never have to pay the taxes on those gains because they're unrealized until you sell. But if you donate them, then you're not selling them. The charity gets the full fair market value, and no one pays the taxes. So everybody wins there besides the government. Um, okay, and then tax credits that matter. This is a very big topic too. So just briefly, there are child tax credits, which is up to $2,200 per child now, and that there's a portion of it that is refundable. I believe it's $1,700 that's refundable. So if if you have a negative tax liability at the end of your scorecard, which is your 1040, then you'd actually get money back. But there are a lot of phase outs for these credits. So again, that's where that AGI or modified adjusted gross income comes in. And yeah, let's see, education credits. There's the American Opportunity Credit, which is up to $2,500, but that can only be used for the first 4 years of post-secondary school. Lifetime Learning Credit is up to 2,000, but that can use for any post-secondary beyond 4 years even. But again, all these come with phase outs. And then energy credits, a lot of those just expired at the end of last year. I was trying to look up which ones actually still exist. There's one that's the New Energy Efficient Home Credit, which is set to expire June 30th of this year. So if you're having a new home being built, that might expedite the timing because it has to be finished by then. So be careful of those. And yeah, there's a lot of other ones. We'll get into the ACA premium tax credit in a bit as well. All right, let's keep it moving. Okay, this one is me as well. All right, so where your tax dollars live matters. So this is another one of the levers that Vivian mentioned. We talked about this first line already. Taxable, tax deferred, tax free. The investments that you have in these different types of accounts matter a lot. So my favorite example is California municipal bond. So if you own a California muni bond and you live in California, you get the interest tax-free both federally and for state. Okay,
So
so
Jamie, how would you know that you have one? Is that something you'll get a form in the mail or
uh, well, like if you work with us, if you work with Brio and you have a taxable account, we are investing, and you live in California, we are investing in California municipal bonds.
right?
Yeah,
Okay.
and all of this stuff shows up on the
On the
consolidated
consolidated.
1099.
Okay,
Yeah,
perfect. Thank you.
yeah. So you don't have to do anything there.
I like
Yeah,
that.
and so obviously Brio already practices these things, so it's kind of more for your awareness. And if you don't have an advisor, this is why you should work with an advisor. Um, but yeah, so California Muni Bond, say it's earning 3%. So since it's state and federally tax free, doesn't matter which account it is. Um, in the tax deferred account, you're going to get the 3% because there's no tax impact there. If it's in a tax deferred account, well, it doesn't matter what the tax benefit is because 100% of the money that comes out of that account is going to be taxable at ordinary income rates. So there's no tax benefit there. So not ideal for that account. And then for the Roth account, well, you've already paid all the taxes on the money in that account. And as long as you meet certain requirements, not pull money out before 59 and a half, and some other nuanced rules there, then all that comes out tax free anyway. So again, you're not really benefiting. So if we're comparing a 3%, California muni bond versus a 2.5% corporate bond, um, you know, we're probably sorry, I did that backwards. 3% muni bond versus a 4% corporate bond. You're going to want the higher return in the tax deferred account and the Roth account because it's going to be 4% either way, or fully taxable either way. But in the taxable account, that's when we care because then, after your taxes, from the corporate bond, you're probably only going to get 2.5% return after tax, whereas the muni bond would be 3%. So where you hold these different investments really matters. So bonds, that's going to give off income. So again, we probably don't want that one in the taxable account because we're going to be paying more in taxes in the current year. So it might be good for the tax deferred account. Uh, REITs are real estate investment trusts. So, that would also be good for like a tax deferred account, high turnover, same thing. So, in the taxable account, we want to be more tax efficient, like the muni bonds. But all these other types of funds where there's a lot of activity that is going to drive taxable events, we want to put those in the tax deferred or the tax free account. Yeah, and then Roth is really the best account for the assets that you expect to grow the most because it's going to grow tax free, pull the money out tax free. Yeah, and so even with good investments, you want to think about asset location because it could be great as an investment, but then if you have a lot of tax hits, then you could be kind of degrading the benefit there of your investment. Okay.
Okay. So, of course, we always want the market to be going up. Everyone benefits, but unfortunately, historically speaking, it doesn't. Right? So, what do we do when we have losses and volatility during these quote unquote bad years? Um, these are just kind of a list of tools that we use to kind of combat that in our own way. As Jamie mentioned before, we have tax loss harvesting, and it's pretty much offsetting capital gains with capital losses. You can offset as many gains as you want. So let's say you have 200,000 of losses and $100,000 of gains. You now have $100,000 of losses that you can roll over every year until all the funds are used. And you now have no capital gains for the year. So you can offset as much as you want when it comes to capital gains and losses. When it comes to ordinary income, as Jamie mentioned earlier, it's only $3,000 a year. Um, and like I said, I just mentioned, you can roll over the remaining balance until it's all used up. And he did also touch base on that wash sale. Just to kind of recap, we don't want to sell out of an investment to turn around and reinvest in the same investment. We want to maintain market exposure, but just in a similar asset. We're not going to turn around and buy the same one. Pretty much cancels out the whole loss kind of thing we're trying to navigate here. And it's just at that point, doesn't benefit anybody. We also have our Roth conversions during drawdowns. So let's say we have $20,000 in an IRA and the 20,000 drops down to 15,000. We may consider recommending to you, we should convert the 15,000 from traditional into Roth. So, if we get your approval and all looks good, we proceed with the conversion. And then let's say the 15,000 jumps back up to 25,000. Well, now all those gains are now tax-free, right? Because we've already converted into the Roth, which is, we've already paid the taxes on those funds. So volatility can be scary. It can be very intimidating for many. However, it can help with our long-term tax efficiency, especially when we're considering these tools here.
Love it. Yeah, Brandon made me do that once.
He's
Yeah.
good at convincing people.
Yep.
Yep. All right. So then we got so retirement distribution sequencing. What funds do we pull from in retirement? This is a really big question and very difficult to be able to navigate without financial planning tools. So maybe a default assumption might be, well, let me just pull proportionally, or just deplete the smallest account first. Definitely, you don't want to do that because then you'll lose your flexibility. So ideally, throughout your accumulation years, you're going to be building up all three types of accounts: your taxable account, your tax deferred, and your Roth account. Um, yeah, I know Brandon is always preaching about Roth accounts. They're excellent, and they take uncertainty off the table because if we've paid the taxes already, then we know this is our money. If we haven't paid the taxes, then we don't really know how much of that money is ours. We owe the IRS at some point down the road. Um, and then regarding the next column there, the managing RMDs. So RMDs is required minimum distributions. So depending on your birth year, if you're born in the 50s, your required begin date is going to be when you turn 73, the year you turn 73. And then if you were born after the 50s, then it's going to be 75. And of course, that could change down the road, but for now, those are the numbers. And so, starting in those years, you're going to be forced to pull money out of your tax deferred accounts. I think I looked at the tables, and they're all based on your life expectancy at a given age. So as we get older, our life expectancy is reduced. And so basically, if your life expectancy is 15 years, you take your account balance at the end of the previous year, you divide that by your life expectancy, and that's how much you can expect to pull out in the next year. So I think 73 was 3.77% of the account. So it starts out pretty small, but then it continues to grow. I think it goes up to as high as 50% when you're like 112 or something. Um, but yeah, so we want to be careful about that because we might not need all of the money that we're being forced to pull out. We say, hey, we don't really want this money. Well, we have to pull it out. And that could affect, again, IRMA, which is your Medicare premiums. And most of our tax brackets are progressive. So the next dollar doesn't impact the previous dollar. With IRMA, it does. It's known as a cliff. So if you go $1 over into that next bracket, then you're paying that higher premium, which is at least $1,000 more per year per person. And so we want to be very careful about our income sequencing and timing and how much our different accounts are growing. So generally, and again, with nuances, doing a lot of heavy lifting here, we want to kind of start with our taxable accounts since generally we have long-term cap gains, so it's going to be taxed at lower rates. So we can kind of start there. Or you could kind of consider that one and tax deferred accounts in the same vein because we want to control for that. We don't want to let those tax deferred accounts grow too high for those reasons I just mentioned. And um, sorry, I lost my train of thought. Um, yeah, so we want to we can control our tax bracket and our tax bill by pulling money strategically from the taxable accounts and the tax deferred accounts. And then if we still need money, then we can pull from the tax-free account to kind of supplement. But keep in mind too that the Roth account is a really good account to let continue to grow tax-free and use in your later years in life. So we're not increasing our tax bill at a time where maybe we're in a long-term care facility or something like that. And also, if we're going to have somebody inherit the money, it's always best to inherit a Roth account because then they're going to pay taxes on it. So so there's a lot of strategy here. And one of the other obstacles is Social Security taxation. So your Social Security income can be taxable anywhere from 0% up to 85%. And some of this other income is deciding how much is taxable. The One Beautiful Big Beautiful Bill Act, attempted to make Social Security not taxable. It didn't do it directly. It is still potentially taxable. The kind of workaround fix that affects some people is there's a new enhanced senior deduction of $6,000 per person over 65 as long as your income is below certain limits and those phase outs are a little bit lower. So if you're single, I believe it's 75,000 it starts to phase out. Um, and then if you're married filing jointly, it starts at 150,000. Uh, and then it's $100,000 phase out. So if you make over 175,000 as a single filer, then you wouldn't get any of that enhanced senior deduction. If you're in the middle, you get some portion.
All right.
Um,
Jamie, we have a couple questions here in
okay.
the chat. So Paula, who is in her 70s, is I think saying, I've never taken distributions. Um, so why would that be the case for what? Tell us how young you are, Paula.
Yeah, so I don't have an IRA. I just have
Oh,
a Roth because I listen to Brandon, right? So I have an investment account that is just I'm going to call it just money, right? So it's just an investment account. I have one that's cash, and then I have my Roth. So does any of this stuff about managing RMDs or IRMAs and stuff affect me?
Yes. So you don't have this tax deferred bucket that I was talking about, like an IRA.
I don't
So
I don't think I have a tax deferred. I do not have an IRA. When I came out of my job and they had a part of my 401k was an IRA, I
Mhm.
immediately converted it to Roth. So right now
Okay.
I have no IRA.
Okay. Yeah, and that's fine.
So then
Um,
R&Ds then don't affect me because I don't have an IRA, right?
Correct. Yeah.
Okay,
RMDs will not impact you if you have no IRA, 401k,
got
403b,
it, got it, got it.
457.
Okay,
Yeah.
okay,
okay.
cool.
Yeah.
Awesome. All right. And then someone else asked previously, could you go over again Roth conversion during a loss year?
Sure,
Yeah.
absolutely.
Oh, go ahead, Vivian.
Yeah.
Jinx. I was just going to reiterate my example. So let's say we have an IRA with $20,000, right? Let's say we are experiencing a market downturn and the 20,000 drops down to 15,000. We may consider recommending a Roth conversion of those traditional dollars into these now post-tax dollars. Once we get the approval, we complete the conversion. Let's say the market goes back up and it goes from 15 all the way up to 25,000, let's just say that gain of $10,000 is considered tax free because you've already paid the tax on those funds with that conversion. So we may not always consider, it is dependent on your situation as a whole, right? But, that could be the case, just considering, if it
Yeah.
works for you.
Exactly. And so we're gonna have to pay taxes on the money in the IRA at some point. And again, this could IRA could be 401k, all the same. So if markets are down and that balance is lower, and we convert 15,000 instead of 20,000, then it's going to be cheaper from a tax perspective. I hope
And
that was helpful.
yeah, and again, folks, there's so much, this is a multi-layered, nuanced thing, and it's case specific for each one of you. But another follow-up question, can we convert money to Roth after retirement? And I
Of
would like,
course.
yeah.
Yeah, honestly, that's oftentimes a very good time to do so because we don't have as much income coming in, especially if we haven't started Social Security yet. We have to meet our needs, of course, first off. So maybe we're selling some from our taxable account. But if we look at our tax bracket, we might realize we have a lot of room left and our tax bills can be really low. We might want to strategically accelerate income and convert money into Roth so then it can be tax free for the rest of your life.
Mhm.
And
Yeah.
that's kind of one of the big things that make it that we differ from CPAs and EAs is, when they're doing your tax return, they're generally trying to optimize to give you the lowest tax bill, the greatest tax refund for last year. But we're looking at your whole lifetime and maybe going counter to what they're saying and say, no,
Mhm.
we want to pay some taxes today because it's going to be cheaper than if we pay taxes later. And one thing we haven't even talked about, actually, I'll save it for Vivian. I think it's on the next slide.
Lucky Vivian.
Okay. Yeah, should we keep it moving? We got a few more here.
Okay, so some common myths and mistakes about tax planning in general. I'll be in a lower tax bracket. We don't necessarily know, right? Legislation can change. The US has a massive debt balance, and it seems inevitable at some point down the line, rates are going to have to increase. And then we have things like your RMDs, as Jamie mentioned earlier. Those are required for some of you at 73 and others at 75. And those affect, your Social Security, which can be taxed between 0 to 85%, which then
85.
affects right? Which then affects your IRMA or the widow tax, right? Roth is always better, often, but not always. You don't necessarily want a $0 tax bill sometimes. It doesn't always reflect that we were the most efficient with your tax planning by the end of the tax year. I shouldn't realize gains. What we discussed earlier, tax gain harvesting, right? So when you have those low income years, we want to maximize by filling up that bucket. So if you're in the bucket of 0%, we want to fill it up as much as we can. So you're still getting some good income, but you're not really affecting your tax bill. And then lastly, my CPA will handle this automatically. It's not necessarily the case. Your CPA only has one side of the picture, and that's how Jamie mentioned, right? They're maximizing your refund, and we're not trying to maximize the refund. So that's why we highly encourage, and if not recommend to all of you, if you have a CPA you prefer to work with, or if we recommend one that you have when you're using, please introduce us to them. Let us connect with them. Let them work in tangent with your advisor so that we can create the best picture and the best recommendation for you.
Yeah. We're on the same team, so let us work together. I believe this is a yes, but a question, can one convert partial fund from IRA to a Roth periodically? So could you decrease it annually just to sort of mitigate? Yeah.
Oh, sure. Yeah, it's unlimited the amount you can convert in a single year. So it can be $1, it could be $1 million, doesn't matter.
$1.
Yeah, I don't see the point of that, but uh, and just to be clear, we don't mean to like make CPAs look bad or anything like
No,
that.
no, 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 no.
No.
We just work, and some of them do a lot of like recommendations for forward looking. Like, hey, you should probably do this. This is going to be good for you long term. But generally speaking, they are a little more concerned with the current year or the previous year, and we're a little bit more forward looking. So that's why we communicate and we work really well. It's a synergistic relationship.
Love it.
Okay. How do we actually implement this? Yeah, so we take all of the above into consideration. We want to look at our investments. That's going to affect decisions around capital gains, dividend income, asset location. All of these things come into play and affect cash flow. And cash flow is really the driver of how we're investing. because depending on how much you need at a certain time. And again, when we move into retirement, that's going to drastically change things, especially if we retire before, like well before Social Security and Medicare, especially now with the Affordable Care Act subsidies going away. There's so many considerations here. We run some basic tax projections. Again, we're not CPAs, so we have to take it a little bit with a grain of salt. Um, but we can come up with some really good strategies that you can run by your CPA and kind of have them sign off on like why this is appropriate for you, or maybe there's something that is very niche to you that we don't know about. They'll be able to clarify that. Um, but yeah, and one-off advice often fails because things change so dramatically year over year. And and there's so many nuances to all of these different provisions. So this is very vague kind of answers here, but just because it is so complex, it just depends on the individual circumstances.
Got
Um, yeah.
Well,
And
speaking of
good.
individual circumstances, we've got a client in the chat who said self-employed and couple who are working less in their mid 60s. They stopped using a CPA because their bill was ridiculous compared to their actual income, have been
Mm.
using TurboTax, and wonders if their advisor, who I believe is Brandon, would be able to advise on things like IRA contributions, etc., now that she's starting to do the taxes.
You said they're retired?
Self-employed in their
Oh,
60s.
self-employed. Okay. Yeah. So the question is, can we give them advice on how much to contribute?
Yeah.
Yeah, again, it all, like I said, it kind of has to come with a grain of salt. Like the SEC is a little bit careful with us giving direct tax advice. So oftentimes it is best to work with the CPA just to make sure you're compliant with everything. There are certain contribution limitations depending on if you're an S corp or a sole proprietor, things like that. So it can get a little bit complicated. We know a lot of these rules. So we can give you, point you in the right direction. We might just point you to the IRS website for that specific type of retirement plan. Um, is that helpful?
I'm not certain, but I do
Yeah,
think I would say, Zadie, is that helpful?
yeah, that's helpful. And
Okay.
you know, to be fair, TurboTax, I use an assisted service.
Yeah.
Mm.
I've done that
So
in the past for complicated years. Yeah.
yeah,
So I think that plus Brio puts you in good positioning.
great.
Yeah. Yeah, I mean, and if you're self-employed, I kind of would like to push you towards using an EA or a CPA. And just for those that don't know, EA is an enrolled agent, and they have a similar but not really the same as training as a CPA. Their license is granted by the IRS directly, so they are federally licensed to do taxes in every state. CPAs are granted their licensure through the state. They often can do taxes in every state as well. But so either one would be great to work with. And, there are oftentimes with self-employed individuals more planning opportunities. Um, again, like what can you write off, these type of things. CPAs and EAs would be able to give you a lot of good advice. So I would encourage you, but if it is truly simplistic, maybe it's unnecessary. Um, and what to bring to planning conversations. So of course, if you're working with us, then we already have all your financial documents, but we're going to need your tax return, financial statements, balance sheet, all of that stuff. But we also need to know, are there expected income changes? Are you planning to change jobs, retire soon? Big purchases, liquidity events, charitable intentions. We need to know all these different things to have a meaningful conversation. All right. Okay, and now to move on with the last 10 minutes here. And sorry if we've kind of been doing questions throughout, so hopefully, but if there are still more questions, we can answer them offline. But so here is a screenshot from our one of our tools called eMoney. It's one of the most popular planning software tools. And I just wanted to show a quick example of some of the things we're looking at. So this shows a married couple that are in their accumulation years, and these bars represent their taxable income base. So they're making really good money, and then they both retire in the same year, and then you can see their income just kind of drops off a cliff, and they're either living off of savings or investment accounts that have low cost, low unrealized gains, and so their deductions keep their income really their tax liability really low. But you can see what happens for them. I think their RMD age is 73. And this is what happens is now we're starting to force money out of those IRAs or 401ks. And yeah, and so it's a little bit inefficient because consider that each dollar on these bars between these brackets, they become more expensive if they're in this bracket. Can you see my cursor, Shannon?
I cannot. Oh yes, no, it's just so tiny,
Oh, sorry.
actually.
Okay. I wasn't sure if it shows. Um,
Dang.
yeah, so in each, so it's not just about how tall that blue bar is, but the section of the blue bar between those lines, those colorful lines, become more and more expensive. As you can see it in the relevant bracket floors, it starts out at 10%, 12, all the way up to 35. And so we mentioned the widow tax earlier, and that's what we can see at the end of this is that triangle shows the first spouse passing away. And then what happens is oftentimes, the surviving spouse inherits all the wealth from the decedent. And then also income generally is the same, especially if most of our income is money coming from Social Security and then also from IRA distributions. So you can see like the income basically is the same, but now we're filing as a single filer as opposed to married filing jointly. So this bar here is way more expensive than this bar here because of the bracket that those dollars are in. Does that make sense? It's a little bit complicated, uh, but let's just look at this. What happens when we do a Roth conversion, which is in retirement in this example, we're going to just move some money from the IRA into the Roth IRA. We don't need it yet. We're not pulling money out. We're just moving it from one account to the other and paying taxes on it in that year. And when we do that, that's what these yellow bars represent. Um, then the net effect here, and this is all in today's dollars. So if we looked at, it's basically solving for inflation. Otherwise, these numbers would be even bigger. But in today's dollars, the net amount saved in taxes for them is about 327,000 over their lifetime. And at end of life of the second spouse, there's an additional 1 million plus of portfolio assets. So this is just one example. I don't even know if this is exactly how I would do it because now we're again not paying any taxes later, but it's better than the opposite, which is to save all of our taxes for end of life. So yeah, I forget who it was. Was it Paula that mentioned that she doesn't have the pre-tax
Yeah.
account. So this is kind of that example, which much preferred over the first example, over this one. But I think ideally we kind of want to spread it out. But we also don't know, if these brackets, even if the dollars, if the width of these brackets don't change, the actual percent that they're charging you could go up, right? So they could make those narrower. That could be one way to increase taxes into the government, or they could just make the rates at which those brackets are set higher. So we don't know. So converting often is a good answer, but yeah, hopefully that was clear.
Okay, 5-minute warning.
Okay, three more slides.
Okay, so I know this looks very intimidating. We're just going to kind of look at this at a very high level. So this is a screenshot from our tax planning software that we use at the firm known as Plan. The x-axis is just representing additional income, and those are your Roth conversions or your IRA distributions, as we mentioned before. And then the y-axis is just your effective tax rate. right? And we kind of just want you guys to look at this and just kind of notice, all the different colors below the chart are just the things that we have to consider in the back end whenever we are doing your tax planning, right? So it's not, when you say I want to retire sooner or I'd like to take extra income out this year, this is just one way we start to look at what does that look like? How is that going to impact you? And, can you do it? Is it efficient to do it this year? Should we wait, etc.?
Exactly. Yeah. Don't try to understand this graph aside from that. It's very complicated. It's very complicated and it's hard to do unless you have a tool like this. So um, just emphasizing the importance of using an advisor or a tax professional that has access to these tools. Okay, and then last topic, Affordable Care Act premiums. So it's not directly a tax, but it is in effect a tax. And I just wanted to show the impact of the the sunset of the enhanced premium credits that just sunset at the end of 25. Now this is still in Congress. They're trying to negotiate some sort of extension. I've heard 3 years as one example. Nothing has been passed yet, so currently there is no enhanced premium tax credits. But this example is I just threw some numbers in a calculator. This it's a really good calculator. You can just Google KFF calculator, and it's a good tool. And plug in, your zip code, how many people are in your household, and their ages. And I think this example is two people with um, in their mid 40s, and so they're self-employed, and their income in San Francisco is $84,000. So that happens to be almost 400%, and that's the key number here is 400% of the federal poverty level. And again, the federal poverty level depends on how many people are in your household. And so their annual cost for a silver plan is $8,366 per year total. So it's about 10% of their household income. And and if we just still had those enhanced premium tax credits, it'd be a little bit less, 7,000. So not a huge hit. But it's this when you exceed 400% level that really matters. And that shows it jumping. So they now make 85,000 as a household, but they're paying 11,000 more in in premiums for their health care. So it is very dramatic. And again, if we still had the enhanced tax credits, they'd only be paying 72.25, which represents 8.5% of their AGI. And that
Right.
was the number as you couldn't pay more than 8.5%. So they removed that limitation, and that's why you hear a lot of people say that their healthcare premiums
Yeah.
tripled, and that's exactly what happened. Now it's almost 23% of their household income just for their premiums. So
All right. So, but you're saying this is still there's an extension that may be granted.
yeah, I mean, it's still in Congress. They're talking about it actively. So we could get those back, but we have to assume that it's not going to happen, or plan for that. And so, I'm not saying that you should make sure your income is below 400%,
Yeah.
but, maybe take inventory later in the year. And if it's going to be close to that amount, you might want to consider certain things like not doing a Roth conversion, or contributing more of your retirement to the pre-tax accounts, tax deferred accounts. If you're self-employed, well, yeah, and most of these either are retired or prior to 65 or self-employed, and so oftentimes you have a little more control over your income and expenses. So yeah, anyways, just be mindful of it is kind of the main point. And
Yeah.
that's kind of the main point of most of this conversation today is that there are a lot of different obstacles. Be mindful of them and then continue to educate yourself,
Yeah.
so you can make the best decision possible. And that's it. And this is just a quick chart for the Medicare premiums. Um, if your income is below these levels, 109,000 for single, double that for joint filers. The base Medicare premium is $202.90 per month. And then if you start going one into these ranges, it jumps to these amounts. So this is the total amount you'd pay for Part B. In Part D, the starting point differs depending on your plan, so that's why this column represents the increase. So it'd be 1450 more per month. Right. So it's $1,000 more at each level per person. So just to illustrate that.
Yeah. Okay. Thank you, Jamie. Thank you, Vivian. Thank you, folks. Here are some resources, the KF.org calculators and who's KFF, Jamie?
Um, I don't recall actually.
Perfect. All right. IRS, Tax Foundation, and of course, Brio, your advisor, and your whole team at Brio here is to help you to understand all these acronyms that have been thrown around today and also how to maximize your tax efficiency as well. All right.
Yeah, and if you have other questions, please reach out to your advisor, or if you want to ask me about this presentation in general or Vivian, our emails are jamie@briofg.com and vivian@briofg.com.
Yes, and I can send along a follow-up email with the slides, links, all that good stuff. And thank you, Paula. It's the Kaiser Foundation.
Ah, right.
All right. Honorary employee today, Paula. Thank you.
Yeah.
All right. Thanks, everybody. Have a great weekend. We'll see you
Thank you.
soon.